let me show you before we move on to the next part in the bond ratings. So let me show you an example to get you a clear understandings of bonds. All right. So this example will basically uh, give you a clear understanding how the entire bond really works. All right. So let's look at the features first. As I mentioned, uh, bonds have certain important features, right? Without these features, you cannot really estimate, cannot really value a bond, right? So let's talk about the first one. All right. So the first feature is par value. All right. So par value. All right. So par value is the principal amount that you pay at the end of the maturity of a bond. All right. At the end of the maturity, you pay back the principal to the bondholders. Right. So that is the par value, and par value is the same. It remains the same. It's 1,000 ringgit. All right. Any other question, whether it's stated or not, you can assume it's 1,000. All right. So standard figure, par value or face value equals to 1,000. Alright, the next feature is the bond price. How much the bondholders will pay to purchase a bond. Right? How much will they pay to purchase the bond? That is what we call as bond price. Okay. Then we have coupon. If let's say the question or the scenario or the case stated 7%, that means 7% of the par value, which equals to 1,000. So 7% of 1,000 equals to 70. All right. So coupon means what is the real interest you will pay to the bondholders. What is the real interest? And the next feature would be maturity. All right. As I mentioned, every bond has a duration. It could be 10 years, it could be 20 years, it could be 3 years. All right, but it has a maturity, and then it seems from the beginning mentioned it's a long-term contract. Therefore, it will be more than a year. Right? You can't find a bond less than a year. All right. So with these features, let me show you in a timeline. Okay. Let's say the maturity is, like I mentioned, 5 years. So you have year 0, 1, 2, 3, 4, 5, and then year 0 means beginning of the period. All right. So beginning of the period, you would pay a bondholder. Right. We are looking for the investor's point of view. The investor will pay the bond price, which is 1,080. All right, 1,080. And we put it in a negative, right? The reason we are showing in a negative or in a column is because, all right, is because we want to show it as a cash outflow. All right, so negative outflow. So since it's cash outflow, we're showing it's negative. It means the cash outflow for a investor. Okay, so that is the only one-time outflow from the investor. This is what they pay. In return, all right, in return, what will they receive from the bond or from the investment is two things. They will receive coupon and they will also receive a par value. So let's look at the coupon. This is the year 0 as the beginning. All right, year 1 onwards, every year they will get coupon. Coupon means real interest, right? So this is the real interest they will earn until end of the maturity. Therefore, each year they'll be getting 70, 70, 70, and 70, right? And end of the maturity, here they will get back the par value, which is 1,000. So this is basically how the entire ordinary bond, right? There are just now special cases, right? But this is how the ordinary bond works. Only once there was a payout, After that, you receive coupon, which is the real interest, and at the end of the maturity, you get back the par value. All right. So this is how your ordinary bond works. Okay. So most of the questions will be based on this. They will give you these futures. All right. Then you're required to calculate either the bond price or either the coupon. All right. So we're going to learn in depth on that. All right. So we also looked at different types of uh, bonds, right? Under the bond contract, we say variable rate notes. Floating rate notes means here the coupon is fixed. All right. Ordinary bond, we can assume the coupon is 6, which is until end of the maturity you get 7%. There's no change with that. All right. So your bond price is fixed. All right. You purchase only once. Your interest rate is fixed, and the par value is also fixed. Okay. So variable rate note assumes your coupon rate might differ based on the market interest rate, right? And then you have a bond. Okay, zero coupon bond. So let's talk about zero coupon bond. All right, what will happen if it's a zero coupon bond? Zero coupon bond means zero coupon bond. Okay, zero coupon bond means what they say. There is no coupon. Okay, that is the meaning of zero coupon bond. Okay, zero coupon bond means you don't pay any coupon. Then how it works? In that case, your bond price will be lesser. Okay. Okay. So let's say you're just purchasing for. Let's don't look at the whole thing. Okay. Let's say you pay at a discounted price. You're purchasing bond at a discounted price, and at the end of the maturity, you're earning 1,000. All right, the difference is your earnings, your income. All right, before ordinary bonds, you get coupon every year plus the par value, right? That is ordinary bonds. But if it's zero coupon bond, you're buying at a discounted price, but you don't receive any coupon, but you're gonna get a higher amount. Okay, so that is the zero coupon bonds. Okay, and the next one of the thing you said was perpetual bond. It means perpetual bond means there is no maturity. Every year, what happened? Instead of you don't get any par value, the 70, 70, 70 will be forever. All right, so that is perpetual bonds. The next one would be you have serial payment. Okay, this is the serial payment. All right, serial payment on the other hand. All right, so just now was 180. Okay, so let's assume the whole thing similar. The whole case is similar. All right, previously you were getting 70, 70, right? Every year. If it's a serial payment, you will be getting coupon plus the par value combined together. Okay, which means what? You will be getting around, instead of getting 1,000, you divide that and provide that each year equally. So you'll be getting like 270. All right. So serial payments, you're not getting one lump sum, but you will be getting coupon plus the portion of the par value each year. All right. So that is serial payment. So that is how we have different types of bonds. All right. So class, but remember what we are very focused on is the ordinary bonds with whatever the examples I give you earlier. All right. So we just put back the earlier example where you get 70, 70, 70, and end of the maturity you get half. All right. So that is these are the ordinary bond. Okay. All right. So with that, let's continue. All right. So the next slide, you are seeing bond ratings. Okay. What is bond rating? Every bond that have been issued in the market, there are rating agencies. Right. In Malaysia, you have Mark, you have RAM. All right. In internationally, you have S&P, Moody's. All right. These guys or these companies, their main motive is you need to value a bond. You need to give them a rating based on the quality of it. All right. So you have over here triple A, double A until triple B. Those are called investment grade bonds. Okay, and those below are called junk bonds. Okay, so investment grade bonds are, especially the one the top triple A, has the highest quality. All right, highest quality means they're extremely stable and dependable. Usually, all right, usually the government, all right, government bonds usually get a triple A. The reason is government bonds have the least risk, right? Because we assume if you buy a government bond, you will definitely get the interest paid and also get back the par value without any risk. Because, alright, normally we assume governments never go bankrupt. The assumptions, of course, how the government perform, you will give the rating, and AAA has the least risk. Therefore, they get the highest grading. All right. As you go below, all right. As you get below, it's getting downgraded from triple A to double A, single A. All that is because of the quality. The risk of the bond is increasing. As you keep on increasing, those becomes already junk bond, means high risk. All right, you might invest. The chances of not getting back the interest or not receiving the principal is high. All right, as you go below, the risk increases. All right, so the highest has the highest grade. Okay, so me ask you a question. What do you think our Malaysian government bond rating is? Alright. What do you think our Malaysian government rating is? Can anyone guess? What do you think? What are you guys thinking? Is it double A, single A, triple B, or what? I don't know. Previously in classes, some students say it's double C, double B. Some even say like single C kind of thing. Don't worry, our government is not bad. They are pretty good. They are still under investment grade. Alright, they are in single A. Alright, currently they are in A minus. Alright, one point of time they were in double A. Right, so now they are in A minus. Malaysia is A minus, or in Moody's is A3. So what about other countries? What other countries you think they are in triple A? Alright, the last time I checked, Australia, Canada, Germany, Singapore, alright, all those are triple A. But class, it is not permanent, alright. Every year, these companies, Moody's, S&P, they will reevaluate according to the market, according to the quality of the bond, according to the stability of the government and the economy, they will give a different rating. All right. So if you want to check further, of course, you can Google and find out what are the ratings given for each of the governments. All right. So ours is Malaysian government is A minus. So we have still many positive investment qualities. All right. So let's move on. Okay. So let's start with the fundamentals of bond valuation process. The price of a bond represents the present right. So class, remember what you studied previously, present value. Alright, the present value will be applicable in bond valuation as well. How does it use how we use that? Here, future interest payment plus the present value of the par value. So remember what are the two income that you receive from the bond. If you are bond holder, you receive interest and also par value. All right. So whatever interest you get in the future and whatever the par value you get in the future, all those, all right, those are future value, right? Discounted to calculate present value. Whatever you income that you receive in future, all those discounted and find the present value. That amount is what you price a bond. Alright, that is your bond price. So bond price is equal to present value of all your future income. Alright, so the concept here, and of course not only for bonds, even for many other valuations, we use whatever future income you're generating, all the future income, discount it back and find today's value. That is the price. Alright, so the bond price is calculated based on that. Okay. Alright, so this is basically the formula. This is the coupon. Alright, so 1 plus I. Alright, if you bring it here, it becomes negative n, right? And this one also par value. When you bring it up, it becomes negative n. So we use the present value formula to calculate. Can you guess, class? How we calculate the interest and the coupon, the income based on coupon, and also income based on par value? What do you think? Are you going to use present value annuity or present value? Let me just ask you in this way. Are you going to use present value annuity and present value? Are you going to use both or are you going to use only one? Alright, so some of you might guess it correctly. Yes, you need both. You need present value annuity to calculate the coupon, since coupon is repeating every year. It's the same amount repeats, while the par value is a single sum, therefore use present value. So to calculate bond price, you need to calculate present value annuity plus present value annuity for coupon plus the present value for par value. You combine both, that is your bond price. Okay, let's do an example here. Assume bond pays 10% interest on 100 for 20 years and has a maturity value of 1,000. Alright, the interest rate is 12% and the present value of the bond using annual compounding is, alright. So what are the features that you know? 10% interest. So class, okay. You have one is 10% interest and then you have interest rate in the marketplace is 12%. So class, you have to be clear here. Okay. So this 10% interest that you pay to the bondholder is what we call as coupon. Okay. And this 12% is the market interest rate. Alright, the market what do they charge? What do they charge in the market? Market interest rate is 12%. So this is different. This is the in your present value calculation. This is the I, right? This is used to calculate the annuity or PMT. All right, this 10% interest times 1,000, you get 100. Okay, and N is 20 years. So N is given, I is given. All right, 100 is the PMT or annuity, and your maturity value or par value is 1,000. So that is your FV. All right, so FV, annuity, A, N, and this is your I. Alright, so you have all the information, therefore you can calculate. Alright, so we have present value of coupon payment plus the present value of the par value. So over here, N equals to 20, I equals 12%, annuity is 100 times. You can take present value annuity table. Alright, under N equals to 20, I equals 12%, you can get 7.469. Alright, so 100 times 7.469, you got 746.90, and then you have 1000, N equals to 20, I equals 12%, use present value table, then you can get 104. Alright, so class, you have present value annuity of coupon and present value of par value. Both this amount combined together, you're going to get the value of your bond, which is 850.9. So that is your bond price. Whatever income you get in the future, you discount it, that's your bond price, value of the bond. Okay. Alright, so this is just another way of showing how it's done. Alright, so class, this is another example. Assume a bond pays 10% interest. Alright, but this is a semi-annually, therefore 5% every 6 months. Okay, so class, 10% over 1,000, therefore your coupon is 100 per year, right? Since your semi-annual is 50. Okay, and for 20 years, and as a par maturity value of 1,000, the interest in the marketplace is 12%. Calculate the present value of the bond using the semi-annual compounding. Alright, so class, this is for you to attempt. Take a piece of paper or note. Okay, so N is it 20? Class, is it 20? Alright, if you can understand the present value that we learned earlier chapter, then you know if semi-annual means N times 2, right? So if N equals to 40, your annuity is 50, your R is 12%, and your future value is 1,000. So we have all the information. You can calculate present value annuity for coupon and present value par value. So class, can you take your time, pause the video, alright, pause the video, take your paper, pen, present value table, and then start calculating what is the bond price. Come on, go ahead. Alright, so I hope you tried, and I hope you get the information correctly, right? Semi-annual means, did you divide the 12% by 2? Right? Because your interest rate is per annum, therefore it's a semi-annual means you have to divide 2. Therefore it is 6%. Okay, let me give you the answer. Your present value annuity of your coupon is equals to 752.31. I repeat, your present value annuity of your coupon is 752.31. Your present value of your par value equals to 97.22. 97.22. So your bond price equals to present value annuity of coupon plus the present value of your par value. Therefore, you should be getting 849.53 cents. Alright, so your answer is 849.53. That's your bond price. Alright, so class, if you didn't get it right, attempt it again. Alright, until you get this answer. Okay, so all this calculation questions, without practice, you never gonna perfect it. Right? Alright, so let's move on to the rates of return. You have three types of return: current yield, yield to maturity, and yield to call. Current yield is the simplest form of yield. Yield calculation return. It means yield means return. So we want to calculate how much return are we getting, right? So current yield means annual interest payment divided by price of the bond. For example, 10% of coupon rate, which is 1,000. 10% of 1,000 is 100. Out of the bond price, which is 950. So 100, your interest payment, your coupon, divided by the bond price. That means 10.53%. That's your current yield. Current yield means we are calculating for that particular year. Alright? Therefore, it ignores the capital gain or losses. Why? Because this does not include the par value, the principal that you receive under the maturity. Right? So that is the issue here. Current yield ignores the capital gain or loss. Alright, so the second yield to maturity, is what we're going to be focusing on, because this is what will be used for our calculation questions, right? Yield to maturity. So how do you measure yield to maturity? It considers annual interest rate received, right? That's your coupon, and then the difference between current bond price and the maturity value. Alright, we need to know the bond price and also the maturity value. Maturity value usually, as I say, 1,000 is fixed. Therefore, we need to know the bond price as well. It can be higher than 1,000, it could be lower than 1,000. But class, you cannot find bond price which is like 200, 300. No, it will be in the range of 800 to 1,200. That's a range you could move on. If you get 500, means that's something wrong. Alright, so remember that. And the number of course, and the number of years of maturity. These are the important factors you require in order to calculate the yield to maturity. So what is yield to maturity? It's the interest rate at which you can discount the future coupon payments and maturity value to arrive at a quoted price of coupon. Remember, just now, for the time value of when we're calculating the bond price, we use I equals to 12%, right? Yield to maturity is the I. That's the market interest rate. So we can calculate the yield to maturity in other words, what is your yield, overall return if a bondholder if he keeps the bond until it matures. You see, for example, with the example just now, for if a bondholder paid 1,080 the beginning, and he received all the 70, and 1000. Overall, what is the return he get per annum is what we call as yield to maturity. All right. What is the overall return a bondholder receive per annum? All right. This is a per annum calculation if he keeps until the maturity. That is called yield to maturity. Okay. There are some assumptions. All coupons are reinvested at the same yield to maturity rate. All right. All right. So let's. These are the formula to calculate yield to maturity. All right. So this is supposed to be YTM, yield to maturity. Okay. So how do you calculate? You have coupon payment. All right. Just now example we use 70, right? So 7% means 70, 10% means 100. So coupon payment plus par value is, it's fixed 1000 minus the market value. Whatever the market value is, you minus this whole thing divided by number of maturity, the duration of the bond. Then once you get the whole thing here, divide by 0.6 times the market value, means the bond price, plus 0.4 times the par value. So 0.6 and 0.4 is fixed. That's a formula. So you don't change for any different questions. This is fixed. 0.6, 0.4 is fixed. So what do you do? Usually you calculate this portion first, then plus with this, then divide with the below here, 0.6 plus 0.4 par value. Then you will be getting the answer. That's your yield to maturity. Okay. Alright, so as you can see here, the yield to maturity example is like the previous example where we used to calculate the bond price, right? But now the bond price is given, the interest payment is given, which is 100, the coupon. Alright, this is the coupon, right? And the par value given, N is given, and you're required to calculate the I. Alright, so if we use the same formula that we just learned earlier, alright, your coupon payment would be 100, par value is 1000 minus 850.90 divided by 20, 0.6 times 850.90 plus 0.4 times 1000. Alright, so if you do this calculation, you will be getting 11.8% precisely. Alright, 11.8% precisely. But you can, if you convert that into if you round off to the nearest decimal points, 0 decimal points, you'll be getting 12%. Alright, 11.8. If you just round off, you'll be getting 12%. Okay. Alright, then we have another type of yield. It's called yield to call. Alright, yield to call, you have the special condition where you can settle the bond before it even matures. Right? In my the example I given beginning, the maturity is 5 years, right? If it's yield to call, if it has the call provision, then you don't need to wait until 5th year. Maybe in the 3rd year itself, the company can settle the loan. Okay, so that is yield to call. Again, of course, it depends on the coupon rate, length of the time. You can call the date, call price, and the market price. So let's look at the example here. It's a 20-year bond issued at 11.5% interest rate, and was callable at 1090, right? 2 years later, the yield to maturity on the bond is 9.48%, and the bond is selling at 1180. All right, and the investor who buys the bond 2 years after issue can have this bond called back at 1090. So the computed yield to call determine the approximate interest rate that equate to 1180 investment today with 115 per year the next 3 years, plus a payoff of 1090. Alright, so class here we are asked to calculate approximate yield to call, not YTM, this is YTC. Okay, so what is the coupon rate? 150. Okay, it's given. And then what is the call price? Alright, so here we don't have bond price, we have a call price. So your call price is 1090. Alright, so instead of bond price, you just replace the formula from bond price to call price. Okay, and then next, the market value is currently it's selling for 1180. So your market value, okay, so this is the market value, which is the bond price. The 1090 is the, instead of par value, you have the call price, right? This is instead of par value, because you don't wait until it matures, you called it before that, so that is why you have call price. Next you have N, right? So number of periods. Here it's a 20-year bond, but you can call it after 5 years of the issue, right? And this happens up 2 years later. So you have only 3 years to make the call. Therefore, your N becomes 3 because you're calculating yield to call. Alright? So after it issued, after 2 years, you're finding your yield to call. Therefore, you only have remaining 3 years for your calculation. That's why N equals to 3. So if you do the example, yield to call will be equals to, your coupon is 115 plus you have your call price will be 1090 instead of par value minus 1180. That is your bond price. Your N equals to 3, right? Because alright, so N equals to 3 because you're buying it after 2 years it was issued and you only have 3 years left, right? So using the formula again, so class is just the same exactly compared to the previous. The only thing you're changing is from par value become call price, and your N is the duration of call. Alright, instead of duration of maturity, you have duration of call. Alright, so your answer would be 7.43%. Alright, so that is your answer for yield to call. Alright, so class, if you see, they say the yield to maturity is 9.48%, which means if you keep the bond until 20 years, right? If you keep until 20 years, you receive 115 every year, and at the end of the maturity, you receive 1,000. So with the 20-year calculation per annum, you get 9.5%. But since you are calculating yield to call, you're not waiting until end of the 20 years. You are just going to sell it in next 3 years. Therefore, you only get per annum 7.43%. All right, so that is why it's 205 basis points. All right, it's about 2.05% lesser than your yield to maturity. Okay. All right, so before we move into the next part, okay, so let me give you the practice questions, right? So you need to practice as well. All right, so class, here is the 4 examples you are required to calculate. All right, is for you to practice right now. So again, take your stationaries, and then you can start your calculation. You have 4 examples, and these 4 examples will be used. I'll be using this to give you a clear understanding of what was the special case. All right, if you still remember, it is slide number the slide number 6, when I say key concept of the coupon rate, right? If you finish this, then I can explain to you what the key concept we're talking about earlier. Okay, so class, come on, you can take down this information. Par value equals to 1,000. Your bond price is 180. Your number of period is 30. Your coupon is 100. So calculate yield to maturity. That is the first question. This is the second question. All right, with a different bond price, number of periods, coupon rate. And then you have the third example. The par value, bond price is the same. Your coupon is 100 or 10%, and equals 20. Calculate yield to maturity, and then number 4. All right, so class, you can pause the video now and try all 4 different examples and keep the answer, and then you can check. Right, so class, pause the video, start calculating the yield to maturity for all these 4 examples. Alright, so class, I expect you have completed all those 4 examples. Let's check your answer. Alright, so the first question, your par value is 1,000. Par value is 1,000, bond price 1,080, and equals to 30, coupon equals 100. So coupon 100 plus par value minus bond price divided by 30, your end. Suppose you calculate this, then the whole thing here, then plus with this, then you calculate 0.6 times 1080, 0.4 times 1000, you should be getting 9.28%. Alright? So for the first bond, you can say you're purchasing at a premium. Because premium, why premium? Because it's more than 1000. Alright? So you're purchasing at a premium, and this is your yield to maturity. Then the second one, you're purchasing at a discount, alright, lesser than 1000. And you start calculating, you should be getting 8.5%. That's your yield to maturity. Question 3 on the other hand, example 3, finally you get 10%. And then here, number 4, your par value, it's the same with all the different bond price and coupons, you're getting 10.3%. Alright, so what was the chapter? Slide 23. Let's look at the key concept I mentioned earlier. Yes. So this is the key concept that I want to explain using examples. To the extent that the interest rates in the market go above or below the coupon rate, the market price of the bond will change from par value. It means what? Here with the example, if, alright, if your yield to maturity, alright, if your yield to maturity is lower than your coupon rate, then your bond price is higher than your par value. See, if your yield to maturity is lower than your coupon rate, your bond price is higher than your par value. Here, if your yield to maturity is 8.45, right, is higher than coupon, then your bond price, can you guess, will be lower than your par value. It's vice versa. Alright, previously your yield to maturity lower than the coupon rate. So class, what is the coupon rate? If 100 means 100 divided by 1000, it's 10%, right? So your yield to maturity is less than your coupon, then your bond price is higher than your par value. Here, if your yield to maturity higher than coupon, your bond price will be lower than par value. So that was the key concept we're talking about. Here, what is that? Your yield to maturity is equal to your coupon. What happens? Because your coupon is 10%, your yield to maturity is 10%, your bond price is equal to your par value. See, if your yield to maturity is coupon, say, your par value and the bond price is also same. Alright, so what about you? Can you guess? Your yield to maturity is 10.3, your coupon is 10, therefore higher than coupon. So how is your bond price? Your bond price will be lower than your par value. Alright, so that is the reason, that is why I ask you to do all 4 examples to show you the meaning behind it. As whenever your yield to maturity changes or the market interest rate changes, your bond price will also change according to the changes in the yield to maturity. Alright, so that is the key concept all about. Okay, so with that, let's go to the let's talk about the movement of interest rates. So investors always wish to make substantial profit, right? They want to make substantial profit on the bond market. So what they do, they try to anticipate the direction of the interest rate, whether they're going to increase or whether they're going to reduce. Short-term interest rates may not have the same direction as long-term, so it is really, really difficult to estimate. All right, it's very difficult. That's why you have actuaries in the insurance companies to have this kind of prediction, because whenever the interest rate changes, the changes in interest rate is very hard to predict, right? It's very hard. If you can able to predict, then you can make substantial profit, of course. Even the short term, the way it moves, it's different from long term, all right? So sometimes just an coincidence indicator, okay? So the factors that influence the interest rate, what are the factors? Based on inflations, all right? If the country's inflation is too high, the interest rate will be lower, all right? Changes according to that. Sometimes the way it reacts can be totally against, could be counterintuitive as well. And demand for your funds, all right? The individual demands, the business demand, the government demands. Again, demand versus supply, in fact, also influence interest rate. Desire for savings. All right, countries like Japan, where people who love to save, so they have so many uh, individuals where they love savings. Therefore, when you have so much of supply, all right, many people are savings. The fund, uh, their savings. Sorry, when people start saving more, right, what will happen? The interest rate given, like in Japan, the FD is very low. The interest rate they provide for FD is extremely low, because the government wants them to spend. All right, for an efficient economy, you need to have a lot of expenditures, right? In Malaysia, I think you don't need to worry about that, because you know whenever you go to a mall, okay, you don't talk about currently because the situation is different, but other than that, all the malls is always packed with people, because Malaysians love to spend. Alright, so as long as we spend, the economy will be, it'll be going. You don't need to worry about that. When the time everyone start saving the money, there's no fund, there's no cash flow in the market. That is when we might be having issues, right? Because there's no cash flow in the economy, right? So that is also influencing interest rates, and of course, the bank policy, money market uh, policies also will affect the interest rates. So, what are the investment strategies? If an investor believes the interest rate will fall, what they do? If you think in the future, the interest rate now, the interest rate is 7%. In the future, you think it's going to reduce to 5% or 4%. What do? You buy long-term bonds. Why? When you buy a long-term bond, let's say you buy for 10 years, and they say they're giving 7% per annum. So you don't need to worry, because next 10 years, the interest rate is fixed. Alright, the coupon rate is fixed. So you don't need to worry whether the interest rate will fall. Alright. And of course, if you think the interest rate is going to increase, what do? You buy only short-term bonds. Alright, so that in the law, you don't need to buy 10-year loan. You just buy maybe 3-year bonds. Alright, so that after, in the future, when the interest rate increases, later you can buy a different one. Alright. And of course, class, you can read this, the pricing rules. Alright, so just now to give an example, your bond prices and your interest rate is inversely related with all the four examples I give you just now. And prices of long-term bonds are more sensitive than the short-term bonds. Alright. Again, sensitivity increases, decreasing rate at maturity. Alright, this sensitivity, inversely related, all that, if compared to 2 years bond, 20-year bond, it's less likely the sensitivity. Alright. And of course, yield to maturity also will affect. Prices of low coupon bonds are more sensitive than high coupon bonds. Okay. Again, another factor is yield to maturity is low than when yield to maturity is high. Alright, so these are the factors that can affect the overall bond price. Alright, so class, this is a practice as well. So you can take a piece of paper, you start calculating the bond price. Alright, your coupon is 6.375%. Alright, so remember the amount would be, you have to times with your par value, and this is your yield to maturity, and n equals to 5. So class, why will you calculate the bond price? I'll just give you the final answer. The final answer would be 935.55. Alright, so try to work out your answer. Alright, so with that, I'm completing our chapter on bonds.